we're growth investors. I'm pretty confident that everybody in the room has a pretty good understanding of how Hyperion invests. If you don't, please get in contact with the Pinnacle guys to set up a meeting with us at Hyperion. We'd love to take you through it in detail. But just from the top, what we're really looking for are the highest quality businesses in the world in that growth space. They'll have disruptive technologies or strategies, sustainable competitive advantages, and structural tailwinds. What we're really trying to avoid are what we call old world businesses. And these are the things that generally make up the majority of the exchanges around the world. They've got high sensitivities to economic growth around them. They've got low or no growth over the long term, and they're at danger of being disrupted by the companies that we're looking to invest in. And importantly, we're trying to avoid fads, early stage startups and concept style businesses as well. It's been a pretty good year and 2 years for Hyperion as we've moved further away from the duration drawdown of 2022. And what you can see since then in the pink shaded area is US 10-year bond yields, and they've effectively been range bound around that 4 to 450 basis points over that time. And what you can see in the blue line there is the Hyperion performance really starting to step ahead and generate some strong alpha for our investors. Now, as we're looking forward in this more normalised rate environment and Trumpy 2.0, stability is really key. But even if you are worried about some type of inflation that Trump 2.0 might try and generate, you have near-term evidence of what our portfolio can do in an inflationary environment, more importantly, in a stable 10-year bond yield environment. It's not the absolute level of where rate sits, it's the rate of change. We've been pretty stable for some time. Our 1 year and 2 year performance has been really, really strong. But what we'd really like you to do is look at the 5 year numbers that we have with our portfolio. And as you can see, the global product and our domestic products have produced some really strong returns over that whole period that we've been through, which has been unlike anything else. 5 year encapsulates 2019, which is effectively the last normal year we really had before we moved into the COVID lockdowns, the stimulus, the inflation, and the 10-year bond yields, or the bond yields really spiking from nothing and going higher. Our 5 year numbers, interestingly enough, for our global product, are actually higher than our 10-year and our inception numbers. So the patient investors that have been with Hyperion through that period of volatility have been really rewarded. You've actually done all the hard work. You've gotten to the point where we are now. Now it's time to really enjoy a more normalised environment. There's two key advantages that Hyperion likes to exploit in markets that I've spoken about at length a few times, and that is the quality anomaly and time arbitrage. But there's also two big, large false narratives in marketplaces that we have to battle over time. And these are generally the feedback that we get from our investors. The first one is markets have never been this concentrated. And the second one's a good one because you hear it constantly. Valuations are too high. So I'm going to try and step you through these and why we think and prove to you why they are actual false narratives in marketplaces. We're taught in school that returns come in a nice orderly bell curve. That couldn't be further from the truth. Equity returns come in a power law, as you can see on this graph here. This isn't a feeling, this isn't an opinion of us. We have written a large white paper, scan the QR code, give it a read. It's actually quite good. It basically tells you that we are in a winners take all marketplace, and equity returns have always been concentrated into the few winners. So how do you take advantage of that? Well, you build yourself a portfolio, a concentrated portfolio in a power law setting. So with Hyperion, our top weights are anywhere from 12 to 13%. Top 5 will be about 40 to 45% of the portfolio. Top 10 will be around 60 to 65% of the portfolio. Then you have a nice body for companies that are trying to battle for more capital at the high end, and a tail for companies that might have some type of maybe cyclical issues or maybe some structural weaknesses that you can downweight to really low levels until you get a better understanding of what's going on. Why is that so important? Well, we've had a look at the 59 companies that we've invested in over time in our global product. The key things to look at is this bold text down the bottom. So over 50% of the value in our portfolio has been created by the top 6 positions. 100% of the value has been created by 29 positions. That means the remaining 30 have effectively netted off to zero. It is extremely important that you have a way to allocate capital to the highest risk-adjusted returns in that power law setting so you can take advantage and build on the alpha that we provide for our investors. We can have a look at the same thing. The graph almost looks the same, but it's vertical in our power law, and our 1 year and our 5 year contributors. If you have the 5 years, it's no surprise those top weights have been the things that have been really pushing performance forward. But what's also been really pleasing to see in the more short term on 1 year, that our middle order is really starting to step up and go from being break even to highly profitable. And that's in companies like Palantir and Spotify, which have done remarkably well over the last few years. Palantir is probably up about 8 to 9 times since we bought it, and Spotify is about 3 or 4 times up since we've bought it. Companies that have done really well being break even, come to profitability and gone from a sales multiple to an earnings multiple. And it's been really pleasing to see that middle order, not just the top order, has been able to push performance forward for our investors. Now we have a concentrated portfolio. We have 23 names in our portfolio, but when we actually break it out by business segment, by EBITDA line, there's over 53 individual businesses held within that group that are in different areas of business. And so what we're really trying to prove here, even though it is a concentrated portfolio, there is diversification within that concentration. We think it's very important to run concentrated portfolios because of that power law. As an active manager, it's very important for us to be able to allocate capital to the highest risk-adjusted returns. It doesn't make any sense for us to diversify out into mediocrity by owning 40, 50, 60 or 70 or more companies. You pay us for active management. If your model portfolio has 4, 5 or 6 managers with 50 or 60 products, you've effectively indexed your portfolio with active management fees. So we'd challenge you to look at concentration, not as a risk, but as a big driver for alpha. The second one is born on fear and negativity, and that is the sky is falling and markets are always overvalued. Now, I did a quick Google search just for overvalued markets and found that it's always there, 2015, 18, 2021, 24, 2020. These headlines always keep coming up, and you have to be optimistic to be an investor. If you're not optimistic, don't invest in equities. There's plenty of good cash products that the Pinnacle guys could probably give to you. The key thing to be looking at to make sure that these businesses are going to step forward and give you positive movement over time is the earnings per share growth that they can generate. So the EPS growth of our global products in the shaded pink area there versus the EPS growth of the MSCI World, which is our benchmark, in the shaded blue area. And as you can see, the further we've got stepped through time since 2014 when this fund was the inception of this fund, the positive jaws have opened up and equity values have risen higher. But nothing's linear, and share prices do move in non-fundamental terms. And so we have a structured approach to take advantage of that. In the graph here, you can see in the blue line, the share price of Tesla, which is probably one of the most volatile stocks on the market, let alone the one in our portfolio. And the pink shaded area is the number of shares that we've held since we bought it in the early 2020. As you can see, all things being equal, if the share price is coming down and there has been no change in our long-term intrinsic value or risk adjustments, we've been adding to that position. And then when the share price has recovered, we've been trimming. We call that top and tailing. That's a very powerful alpha generator for our product. It's generated about 31% of alpha over a rolling 5-year period. So we do have a structured approach for non-fundamental share price moves, and it's a very large alpha generator for our investors who are your clients. We'll just have a quick look at the portfolio. This slide hopefully is very familiar to you. We have these 12 structural themes that diversify risk further in our portfolio, even though it is concentrated. And these are really the driving force of those structural tailwinds that are going to push earnings forward over time. One that you've heard about a lot, and I'm sorry, this is going to come up for the next 10 years, so you better get used to it, is AI and machine learning. The graph at the the graphic at the top there was generated by OpenAI, and it is throwing a lot of shade at DeepSeek. It can't even spell it correctly. DeepSeek entering the game isn't a negative thing. It's really interesting, the innovation that's coming out of China that's effectively at the model training level, which has transformed a process which originally cost around $3,500 to 1/10 of that price. And that effectively what they're trying to achieve is to commoditize or democratize the model training portion of AI. That's phenomenal for the broad uptake of artificial intelligence and machine learning, and really rolls into what our thesis is, that the real value will be created in the application level, us using products with AI and machine learning. And so whether that's the cloud service providers, the guys that have the software, or when we can actually start using the products ourselves, whether it's self-driving with Tesla. If you don't believe in that, jump in an airplane, go to Hawaii, go to San Francisco, hire a car and do it. We did it, it works amazingly. Or Block, Meta, or ASML trying in part of the chip making chain. We didn't have to go searching for these high quality businesses. We've owned them already. They've got positive optionality through innovation within their businesses to bring AI and machine learning to the consumers. And if anything, it's only going to make their product or service even harder to shake out as they get more embedded in their customers' workplaces. So it's a really exciting change, stepping ahead, and it's something to be extremely optimistic about with the wealth generation that we think is going to come. Hyperion in a nutshell, really. I've spoken about earnings a few times today. We've compounded EPS growth at around 21% per annum over the last 10 years in our global product. Looking forward, we can see equity values rising even further. Don't be fearful, about 23% per annum. And if we can continue to generate that type of earnings per share growth within our portfolio, over and above what the benchmark does, around 9%, then we should be able to continue this alpha journey for our investors. Why is earnings per share so important? We've had a look at the returns, the breakup of the returns for our product and the benchmark. 21% of that EPS growth is the thing that actually really drives returns. It's not multiple expansion or contraction, it's not dividends return. And you can see the same thing here on the benchmark. So if your investment case is, or you're worried about 1 year forward-looking PEs, 2 year forward-looking PEs, things look expensive or cheap, I hate to tell you, you're not investing, you're speculating. You need to be looking at the earnings that your portfolio can generate and how that's going to differentiate you from the benchmark and your peer set. Our internal rate of return is running at around 20% per annum, forecast out over the next 10 years, a little bit ahead of the long run average, which has been around 17% per annum. And that's been a pretty good indicator of where our portfolio has been able to generate returns over time. And we're really happy that we've been able to take our investors on a high quality journey. As always, we like to say, to be an investor, you need to believe in a better tomorrow. And at Hyperion, we are leveraged to innovation, we're leveraged to optimism, and we're leveraged to alpha generation. Please come and join us on the journey. Thanks a lot.